Okay, good day everyone. This is Hongkong Land's 2023 results dated 8 March 2024. Right, so we'll quickly go through the key ideas. Right, in Hong Kong, the leasing momentum has softened, right, but the Hongkong Land central portfolio has outperformed the broader Hong Kong office market, right, because of their quality properties, and there's a demand for these quality properties, and they therefore can retain their existing tenants better. Right, for the retail side, there's significant improvement in trading conditions, and the flagship tenants have largely returned to their pre-pandemic level sales, which is a good thing, right? They're making money, so they can pay their rent, right? Chinese mainland, we know that the residential side is in a recession, right? The sentiment has been weak throughout the year, and the sales performance at these residential apartments at Chinese mainland has been better than the rest of the residential apartments because they are focused on the premium residential market, right? So for retail side, there's good recovery in retail sales. For Singapore, the CBD leasing momentum has moderated. Hong Kong Land's portfolio has performed well again due to the fact that they own actually good quality properties, and there's still a demand for these good quality properties, right, due to tight supply. Right, residential market has cooled due to higher interest rates and cooling measures by the Singapore government, right, but their sales at this project has been satisfactory. Right, so we remind ourselves that Hong Kong Land uses a metric called underlying profit to measure their performance. Right, the reason for this is because their actual profit and loss statement, right, fluctuates wildly due to valuation of their many properties, right? So just to give you some context, in 2021 they made a loss, right? 2022 they made a profit, and in 2023, which is this year's, they made a loss again, right? So it looks quite bouncy until you look at why all these numbers appear, right? A lot of it is due to the fact that their properties are revalued, and when they are revalued lower, they have to take it as an accounting loss, right? So instead of looking at that, Hong Kong Land tries to look at underlying profit instead, which they believe is a better measure of how their business is performing. Okay, so you can see from 2021 to 2022, there's a significant drop of roughly 20%, right? And 2022 to 2023, there's a drop of 5%, right? So it looks like their profit margin, the underlying profit has been dropping, but dropping at a lower rate. So hopefully this stabilizes soon, right? So something to note is that they have maintained their DPU, which I was slightly concerned about prior to the announcement of this result. So I'm quite glad that their DPU has dividend per share has stayed constant at 22 cents, right? Net debt is slightly lower. NAV per share has dropped as well, right? Underlying profit is down 5%. We discussed this, all right, based off improved results from investment properties and lower development profits on the Chinese mainland, right? So these are the two main ways they make money, right? Investment properties and development profits, right? For investment properties, they function quite like a REIT, right? They own the properties and they rent out, and that's the income that they get from investment properties, right? For development properties, this one is tougher, right? It's a bit like Bukit Sembawang, which we have covered before, right? The profits are very lumpy and a bit unpredictable, right? Financial position remains strong and dividends have been maintained, right? So that's a good thing, right? Hong Kong office portfolio, the office side is a worry, right? You can see one of the reasons why its average net rent have been dropping, right, consistently over the 3 years, right? The vacancy has been going up to 7.4%, right? This one is just a slight drop, so I'm not that concerned about this. I'm more concerned about the first two, right? This one I'm not going to talk too much about. There seems to be like quite a large amount of area that needs to be either undergoing rental revisions or expiration, but looks like they have actually settled 12% in the first 2 months of this year, right, which is a positive thing, right? So out of 31% that they have to renegotiate the lease, they have already done 12%, and I think the leftover is 19%, right? So in some ways that is a good thing, right? Looks like they are quite proactive in renegotiating their rents, right? So this is why they say that the Hong Kong Land Central portfolio is doing better than the wider market in Hong Kong, right? So this shows that for the wider market in Hong Kong, the vacancy is actually 12.8%, which is quite bad. Yeah, it looks almost as bad as the US office issue, right? The central part is higher in demand, so the rest of the Hong Kong central area, the office portfolio vacancy is 9.9%, but Hongkong Land's performance is 6.8%, right? So their vacancy is the lowest, right? Which is probably, you could say, almost double the performance of the broader Hong Kong market, right? But my concern is that will mean revision happen, which means to say, will this 6.8% trend towards 9.9% or 12.8%? I'm not sure, but hopefully this is not a sign of things to come, right? It has gone up from 4.7% to 6.8%, right? Hopefully they will plateau or actually recover from here, right? So retail side has strong post-pandemic recovery. Won't say so much, except that this number is at least trending upwards in the latest results, right? So you can see that I think this is the most important thing, that finally their tenant sales growth has recovered, although I think this is off the 2022 base, which is affected by COVID. Right, we'll not talk about this. Singapore office portfolio, nothing much to say, is actually stable and still going up, right? Vacancy, yeah, so generally positive results from Singapore, not too worried about Singapore. Alright, so other key investment properties, the luxury retail sentiment seems to be doing okay and recovering. Alright, let's move on to, I won't be talking too much about their development side, because I think it's difficult to predict, and I don't have any expertise and value add to the conversation, right? So I'm just going to look at their numbers at the end, right? So what I want to look at is this, right? So what changed the underlying profit from last year to this year, right? You can see that the investment properties or the REIT-like business, right, has actually improved by 33 million, right? Whereas the development properties, which is the lumpy side, right, has gone down by 131 million, right? And there's some net decrease in financial charges, right? That seems to be due to the fact that there's smaller share of profits from China mainland, right? So I think this is due to the fact that their development properties, you can see the profits are going down, right? So because of that, lower development properties completion and impairment of residential units in Chinese mainland, right? I think highly more due to this, that there's lower tax charges, right? So as the light blue column starts to trend downwards, right, which is clearly not a good thing, right? At least the cost, right, which is the yellow part, is also going down, alright? So that's not too bad in total, right? So those are the reasons for the change in profit, right? You can see the Hong Kong side rental income is the only one that dropped, right? Singapore, China, and the hotel segment have all gone up, right? So generally it's a good thing, right? The development properties are the part that has underperformed, right, due to some impairment, right? Fewer planned projects, lower margins, and impairment on certain residential assets, right? Singapore is okayish, right? Indonesia is slightly better, but not a very big part of the portfolio. You can see that the main part of the portfolio is still Chinese mainland. Right, so I don't think I will talk too much about this, except for I want to see how sustainable their DPU is, right? So we can see that generally the payout ratio has been going up, right, which is a bit scary, right? And this payout ratio from underlying profits, just to be more specific, right? So if we look at their income, right? So we look at just this, how their income comes in, right? We can see that this is the part that seems to be doing well, right? This is like a REIT, right? So it has gone down slightly in 2022, but it has recovered in 2023. So I want to see if this alone can sustain the dividends that they are giving out, right? So what I did was a calculation whereby I removed their development properties profit altogether. So I cut out the 273, I just leave 984, then I minus the expenses, right? And I got a value which is something like the underlying earnings per share, right, will become 20.7 cents, right, which is slightly lower than the dividend that they are distributing. All right, but I think this shows that the dividend is more or less sustainable, because if I just look at the rental aspect, right, which is this part, all right, and minus off these costs, right, which I think I'm overestimating, because based on what we discussed earlier, that if this thing drops, right, I think the expectation is this thing is likely to drop as well. So if we look at that, right, it's likely that they will get something like 22 cents, right, of earnings, underlying earnings per share, right, and that should be sustainable in terms of their dividends, right. But of course, this is the worst case scenario, like, in my opinion, right. So we'll look quickly at their outlook, right. So you can see that their outlook is not very positive, right. They say challenging market conditions to linger through 2024, right. They expect their investment portfolio to be resilient, to give them resilient income, right, because like I said, this is like a REIT, right. Office Hong Kong recovery depend on capital market activity, SG office to benefit from positive rental reversions, right. Luxury retail sentiment to expect to remain healthy. They plan to have more planned sales completions expected on the Chinese mainland, but I'm not sure how it will affect the profit margin, given that China's mainland residential market doesn't seem to be doing very well, right. So residential sentiment in Singapore is moderating, and they expect a mild reduction in full year underlying profits anticipated. That means they expect next year's underlying profit to be lower, right. But how much lower? They say mild reduction. So my anticipation is that next year's dividend should be expected to be retained as well. Alright, so with that, I'll conclude my presentation. Thank you for listening, and do remember there is no recommendation to buy or sell. Okay, thank you for listening.